The Bank of England is expected to raise interest rates at midday today, 13th time in a row. Could go up even by 0.5%, not just 0.25%, to 5%. That could push mortgages up. People are already facing difficult times. That, as we discovered yesterday, the inflation is stubbornly stuck at 8.7%. Let's talk to Harry Kind. He's a consumer journalist at Which. Good morning to you, Harry.
Good morning. Hi.
Thank you very much indeed for joining us. Look, things are looking very bad. This was the subject of the exchanges between the Prime Minister and Keir Starmer, the Labour leader, yesterday at PMQs. Is concerned about the pressure on people. But there's a lot of talk about help going to people who've got mortgages. But really, the whole point of what the Bank of England is doing is to put pressure on people with mortgages and make their finances squeeze, isn't it?
Yeah, this is a kind of a bucket of cold water across the whole economy, basically, to try and slow it down, so it doesn't get out of control. You know, we haven't seen inflation come down like the Bank of England thought it would. That has remained pretty steady and, in fact, has increased when you look at services-only inflation. So the Bank of England is really worried. It's way beyond their targets of 2%. And so this is, you know, the main tool at their disposal, but the cost of that is for mortgage holders who, you know, bought in at tiny percentages, 0.5%, 0.1% Bank of England base rate, and now are potentially facing 5% with an average 2-year fix of over 6%.
Yeah. Now, again, these sort of numbers, they were certainly not unusual until until, you know, 2008 recession onwards. I mean, they really weren't. But people are so sort of overextended now. The number of multiples of your salary that you need to get a mortgage are so much greater that actually, we were saying the other day, experts said this was equivalent of 13% back in 1990. We saw rates go up to 15%, and so many people losing their homes. The big fear is people losing their homes, repossessions, but an awful lot of people, you know, are just basically having to cut every other cost to try and pay these bills. But, you know, this is affecting people on variable rates, people coming off fixed rates. An awful lot of homeowners don't have a mortgage. They're older. They paid their mortgage off after 25 years. What is the answer for people who are struggling right now? They say, look, I've been able to afford it, but we're up to the, you know, up to the limit. Energy costs, food costs, everything else has gone up. We can't make ends meet. What should they do?
Yeah, so the people who this is affecting, they're on those variable rates, they're on the tracker rate because their, you know, their fixed deal ended, and so they're paying these really high levels. The first thing you should do is, if you're struggling, reach out to your bank. Now, if you get advice from your bank, they will not, you know, that won't affect your credit rating. They have an obligation to help you out here. And what they should be doing is offering, you know, basically one of three things. Either a mortgage payment holiday, so you basically put a pause on everything, you continue to accumulate interest, but you get some breathing space to avoid paying back every single month. You could also switch temporarily to an interest-only mortgage, so you're no longer paying back the capital, but you're still paying that interest. Or you could, in the long term, extend the term of your mortgage, go from a 20-year to a 30-year mortgage, which would, and all of these basically mean you're going to pay back more money to the bank.
It's in their interest. It's not in the bank's interest for people to foreclose and lose their homes. Is that, although you'd think, well, hold on a minute, you've got an asset, because that's how, you know, they actually end up taking an asset there. It's a better long-term bet for banks that you don't foreclose.
That's absolutely right. And, you know, banks are doing incredibly well off this interest rate rise because although, you know, we are seeing the higher interest rates for borrowers, savers are seeing nowhere near the same increase.
But it's incredible. The amount of times we do this, I'll always get a text or a tweet from someone saying, well, you're saying it's bad for mortgage owners, but what about savers? Well, actually, there are more mortgage owners than savers. But also, it rarely is good news. People are still seeing like 1.5% interest on their account, on their savings. I mean, the banks are, we know, they're raking in billions extra in profits as a result of this.
Absolutely. And the Financial Conduct Authority have written to the banks.
Oh, well, in that case, it's all sorted then. We know how...
Well, exactly. They have gone for the threat before the threat. They promise onerous interventions if the situation continues. We hope the banks listen to that, but it might be that the FCA writes an even stronger worded letter.
Oh, well, strongly worded letter. I mean, the thing is, you know, there is supposed to be a market, but this is what amazes me. You know, we've got this brilliant free market in this, but they all stick together and they carry on making their profits. We don't have much choice about where, you know, if you're lucky enough to have savings right now. A lot of people will have used those up. People who did all the right thing, but, you know, lockdown hit, furlough and the like. People, I know so many people who, yeah, they were on furlough, great, but, you know, that was it, 26 £26,000 limit. It wasn't topped up. That was less than they were earning, but their outgoing stayed the same. But we mustn't leave renters out of this, must we? Because, basically you've got, give or take, roughly a third of people own their homes, a third of people are renting, and a third of people have got mortgages on their homes. But renters are going to see the impact of this because most people who rent are renting from in a private sector. They're renting from a private landlord who's got a mortgage to pay.
No, that's right. But I do think the main pressure and the main kind of determinant of rents is wages more than the actual costs for a landlord. That itself is a free market. And we are already seeing a position where there aren't enough, rentals to go around. There is way more renters than there are suppliers at the moment. And so that's what's really determining the price there. The Resolution Foundation is saying it is wages and not these costs, because the landlords weren't passing on the lower costs of the lower rate mortgages.
Funnily yes, you're quite right. People, yes, as a general rule, we see this with the petrol forecourts as well, don't we? We never see the price go down. It shoots up the moment prices go up, and it takes about a year to come down again.
Up like a rocket, down like a feather.
Absolutely. Harry Kind, consumer journalist at Which, thank you very much. Good advice there about how you should contact your bank. Do not put your head in the sand. Contact your bank. Contact organisations like Citizens Advice. They will give you advice. There are ways of dealing with this which can just spread the pain out. It's not going to not be painful, but spread the pain out. We'll talk more about this throughout the show. 7:32 is the time. This is Talk Breakfast.